Ever wondered how companies keep track of their financial health? Well, one key tool they use is known as a balance sheet. Imagine you're a detective, and your mission is to uncover the financial secrets of a company. Your best friend in this mission? A balance sheet, of course. So, what's so important about balance sheets? Think of a balance sheet as a financial snapshot. It captures a company's financial position at a specific moment in time, like a photo captures a moment from your vacation. This snapshot includes the company's assets, liabilities, and shareholders' equity. It's a concise summary of what a company owns and owes, as well as the investment made by shareholders. Balance sheets are vital because they provide insights into a company's liquidity and financial stability. Imagine you're considering investing in a company. Wouldn't you want to know if the company has enough assets to cover its liabilities? Or if it has a good mix of short-term and long-term assets? Or how much debt it has compared to equity? All these questions and more can be answered by studying a balance sheet. Furthermore, balance sheets aren't just for investors or business owners. They're also crucial for regulators, lenders, and even employees. Regulators use them to ensure companies are abiding by financial regulations. Lenders look at them to assess a company's ability to repay loans. Employees may examine them to see if the company is financially healthy enough to provide job security. In essence, balance sheets are like the health checkup reports of a company. They help everyone involved with the company to understand its current financial condition and make informed decisions. However, just as you need to understand medical jargon to read a health report, you need to understand financial terminology to read a balance sheet. So buckle up, because we're about to dive deep into the world of balance sheets. Together we'll discover how to read them, what the numbers mean, and how to use this information to make informed financial decisions. Understanding the balance sheet can give you a clear picture of a company's financial standing. Stay tuned for the next scene, where we'll dissect the anatomy of a balance sheet. So, what exactly is a balance sheet made up of? Well, at its core, a balance sheet is comprised of three main elements: assets, liabilities, and shareholders' equity. Let's break these down one by one for a clearer understanding. First, we have assets. These are the resources a company owns that hold economic value. Assets can be tangible, like buildings, machinery, or cash in the bank. They can also be intangible, like patents or trademarks. Essentially, if it's something that can bring in money or reduce expenses in the future, it's an asset. Next, we have liabilities. These are the company's financial obligations or debts. It could be a loan that needs to be repaid, salaries to be paid to employees, or money owed to suppliers. If it's money that the company has to pay out in the future, it falls under liabilities. The last piece of the puzzle is shareholders' equity, sometimes also known as net assets. This represents the ownership interest of the company's shareholders. It's what's left over when you subtract the company's liabilities from its assets. In other words, if the company were to sell all its assets and pay off all its liabilities, shareholders' equity is what would be left for the company's owners. Now here's the key principle that ties all these components together. Assets must always equal liabilities plus shareholders' equity. This is the fundamental equation of the balance sheet, and it's why we call it a balance sheet in the first place. It's a snapshot of a company's financial position at a specific point in time, showing what it owns, what it owes, and what's left for its owners. So, when you're looking at a balance sheet, remember you're essentially seeing a company's financial health in a nutshell. It's a tool that can help you evaluate a company's stability, liquidity, and financial flexibility. Remember, the balance sheet is called so because it always needs to balance. Diving deeper, let's first look at assets. Assets, in the world of finance, are a bit like the tools in a mechanic's workshop. They are resources owned by a company which can be used to create goods, provide services, or generate revenue. From physical properties like buildings and vehicles, to intangible items such as patents and trademarks, assets come in all shapes and sizes. To understand assets better, let's break them down into two main types: current assets and non-current assets. Current assets are like the speedy sprinters of the business world. They're nimble and quick, typically being converted into cash within 1 year. Current assets include things like cash itself, accounts receivable, that's money owed to the company by its customers, and inventory, all the goods the company has made or bought to sell. On the other hand, non-current assets are more like marathon runners. They're in it for the long haul, providing value to the company over a period longer than 1 year. Non-current assets can be tangible or intangible. Tangible non-current assets are those you can touch, like buildings, equipment, and land. Intangible non-current assets, on the other hand, are things you can't physically touch but still hold value. This includes assets like patents, copyrights, and brand recognition. Let's consider a book publishing company, for instance. Its current assets might include the cash in its bank account, the money it's expecting from bookstores who've sold its books, and the books it has in stock ready to be sold. Its non-current assets, however, might be the office building it owns, the printing presses it uses to print books, and the copyright it holds on its published books. So, whether they're sprinters or marathon runners, tangible or intangible, all assets have one thing in common. They're owned by the company and can be used to generate revenue. Assets, in essence, are what a company owns and can use to generate revenue. Now let's turn our attention to liabilities. Liabilities, a word that often sends shivers down the spine of many business owners. But what exactly are liabilities? Well, in the simplest terms, liabilities are what a company owes. It could be a loan from a bank, wages owed to employees, rent for the office space, or even taxes due to the government. Let's delve a little deeper and break down liabilities into 2 categories: current and non-current liabilities. Current liabilities are those that need to be paid off within 1 year. These include accounts payable, which are amounts owed to suppliers for goods or services bought on credit. It can also encompass short-term loans, taxes payable, and accrued expenses like wages or utilities that have been used but not yet paid for. On the other hand, non-current liabilities are those that are due after 1 year. These are obligations that don't need immediate settlement and can give a company some breathing room. Examples of non-current liabilities include long-term loans, bonds payable, or deferred tax liabilities. It's crucial to understand that liabilities aren't necessarily bad. In fact, they can be seen as a sign of growth and expansion. For instance, a company might take on a long-term loan to invest in a new factory or to launch a new product line, expecting that these investments will generate profits in the future. However, it's all about balance. A company with too many liabilities may find itself in financial distress, especially if it's not generating enough revenue to cover its debts. That's why it's essential for a company to manage its liabilities effectively and ensure it has enough assets to cover them. So remember, when you're looking at a balance sheet, don't just focus on the assets. The liabilities section can tell you a lot about a company's financial health and its ability to fulfill its obligations. Liabilities, in a nutshell, are what a company owes to others. Finally, we come to the third component, shareholders' equity. Now, you might be wondering what exactly shareholders' equity is. Well, in the simplest terms, it represents the ownership interest of the shareholders in the company. Picture it as a claim on the company's assets after all debts have been paid off. Let's break it down. Shareholders' equity is essentially what is left over when you subtract the company's total liabilities from its total assets. It's the money that would be returned to the company's shareholders if all the assets were liquidated and all the company's debt was paid off. Now, you might ask, why does this matter? Well, a company with high shareholders' equity is often considered financially healthy. It's a sign that the company has been able to accumulate profits over time and reinvest them back into the business, rather than having to rely on borrowed funds. Speaking of accumulated profits, this brings us to an essential part of shareholders' equity, retained earnings. These are the net earnings that a company decides to keep, rather than distribute as dividends to its shareholders. They are essentially the profits that have been reinvested in the company, rather than paid out to shareholders. And they play a crucial role in the growth and expansion of the company. Retained earnings are a clear indicator of a company's long-term profitability. A company with high retained earnings has been successful in reinvesting its profits to generate even more earnings. It's a positive sign for investors, as it indicates that the company has the potential to generate profits and create shareholder value in the future. Thus, shareholders' equity is a critical component of the balance sheet. It provides valuable insight into a company's financial health and its ability to generate profits. It's a key indicator of the company's financial stability, its growth potential, and its attractiveness to investors. Shareholders' equity essentially shows what's left for the owners after all debts are paid. It's a measure of a company's net value, and it's a fundamental concept that every finance student and investor should understand.
Commit your way to the Lord, trust also in him, and he shall bring it to pass. Psalm 37 verse 5. I can do all things through Christ who strengthens me. Philippians 4 verse 13.